right, so we're going to be talking about our multi-method investing financial markets update. And as usual, when we do this, I want to start with going over just very simply what has happened year to date in 2025 in the financial markets. And today we're talking about this data that I'm about to show you as of November 12th. So this is close of business yesterday, right? Mick, if you could just pan over here, please. All right, so we'll start with, these are all index performances year to date. Indexes are obviously not always the most reliable thing in terms of what is actually happening in investor portfolios, because indexes have flaws. They're not a real thing. They're kind of they're a figment of investors' imaginations, all right, or the index makers' imaginations. But at least they give us some broad idea of what's going on in the financial markets. All right, so let's talk about first world stocks. So world stocks, here we're talking about U.S. large, mid, and small cap stocks. We're talking about international developed market stocks, large, mid, and small cap. And we're talking about emerging market stocks, large, mid, and small cap. So this is the broadest measure of stocks that we're using today, right? And as of close of business yesterday, world stocks were up 21.78%. All right, so that's a pretty good indication of what's going on broadly around the world, right? And this is in dollar terms, right? Now, we break it down further from there. Let's look at U.S. large cap stocks, and here we're using the S&P 500 index as the measure, which is up 17.75% for the year to date. Then we have U.S. mid-cap stocks as measured by the S&P 400 mid-cap index is up 6.21%, so a big difference there between large and mid-cap stocks. All right, U.S. small cap stocks, which is the S&P small cap 600 index, are up 4.84%, so even bigger difference between large cap stocks and small cap in the United States. Then we have international developed market stocks. So international developed market stocks are anything outside the U.S. that is, let's say, a developed market, has a highly developed exchange, right? So we're talking about Canada. We are talking about Western Europe. We're talking about Japan, potentially South Korea, Australia, New Zealand, etc. Right, so these are the developed markets of the world from a financial market standpoint. They're up 29.16%, right? So significantly more than the U.S. markets year to date. Emerging market stocks are up even more. Emerging markets are all of the countries that have an active exchange, right, that are not mentioned. They're not either the U.S. or any of those developed markets I just mentioned, right? So emerging markets are up 33.50%. All right, so they've been wavering quite a bit, but they've been hovering above and below anywhere between up, 25% to up to, again, 33 to 35% for the year. They've been fluctuating quite a bit, but they've been pretty consistently one of the top performers. Is between international developed and emerging markets during the course of the year, they've been the top performers. Emerging markets are now in the lead pretty substantially. Then we're talking about the bond markets. All right, so the bond markets, here we're just talking about inside the United States to keep it simple. U.S. short-term bonds. So this is the Bloomberg U.S. aggregate 1 to 5 year total return index, which includes corporate bonds, treasury bonds, agency bonds of maturities within the 1 to 5 year range, so short maturities. Right, and so that index is up 5.58%, which is pretty good for short maturity bonds, right? And then if we look at more broadly the U.S. aggregate bond index, that is not just short maturity, it incorporates all those different elements I just mentioned, plus longer maturities going out to even 30 years, right, 20 or 30 years. That is up 7.04%. The best performer in terms of U.S. stock bond types so far this year are TIPS, Treasury Inflation Protected Securities, which are up 7.32% for the year. All right, so, and the bond performance for the year to date has been pretty consistent within this range. It has ranged for the most part since the beginning of the year from up about 3% to up to a max of about 7%. So it's been like, mid single digits fluctuating in that area for most of the year. All right, whereas stocks have been, they've had a different performance variability based on what I'm going to show you in a few minutes. All right, so one of the things that you're going to notice here, which I've mentioned in some of these the last couple sessions we did on this topic, is there's a marked difference between the performance of stocks inside the United States versus outside the United States. And there's several reasons for that. One of the primary reasons being the dollar, right? The dollar, or during this particular time period, weakened relative to many other currencies, particularly in Europe and others. That has since moderated. There are other issues around this, such as tariff imposition inside the United States and outside the United States, outside the U.S., and expectations for growth inside the U.S. versus outside the U.S. Right. So all these things together have led to this difference in performance. Right. And you can see that as well in the difference in performance within the United States. Like, so the difference between U.S. large cap stocks versus small cap stocks is pretty substantial, 17.75% versus 4.84%, right? And part of that is because large company stocks tend to derive more of their revenues from outside of the United States versus smaller company stocks tend to derive a large proportion of their revenues from inside the United States. So this is also a reason for part of the reason for the differential here. We could talk more about some of that later if anybody has any interest. Okay, so let's look a little bit more broadly now. Mickey, if you could just pan over to the graph here. All right, so starting back here, going back a couple years now, going back all the way to January 4th of 2022. That was effectively the top of the bull market that followed the coronavirus bear market, right? So January 4th of 2022, we had a bull market top, then we went into a bear market that troughed on October 13th of 2022, right? So this is a more important date going forward, which we'll talk about in a few minutes, right? We knew this was the trough of the bear market in arrears, right? You can only know when a bear market is over once the prior record price, such as that on January 4th of 2022, is reachieved. Because it is possible that you could get a recovery that is a false recovery, never reachieves that prior record and just goes straight back down and goes back down even further than that trough you saw here. But in this particular case, we reachieved the prior record price on January 19th of 2024. So that was when the bull market was indicated, right? So we knew that, at that point we knew that 10/13/22 was the trough, and we knew that since then we had been in a bull market. What happened in the interim period, right, before that January 19th, 24 indication, we also had something called a wolf market. A wolf market, and that was later in 2023, where by our definition, a wolf market is a subcategory of the broader bull market, right? And it's an environment of heightened volatility without any clear bull or bear trend. And quantitatively, we define it as a period of cumulative decline of 10% or greater, but not 20%, plus the recovery back to the pre-correction price, peak price, right? So that happened from July 27th of 2023 to December 8th of 2023. And I bring that up as an example because it's something that we're going to talk about again in a little bit in terms of what the future might look like. All right. Okay, from January 19th of 2024 until December 23rd of 2024, we went into what we call an eagle market. And I'm going to use this again as an example to explain, our forward thinking on this, right? So an eagle market, by our definition, is also a subcategory of the broader traditional bull market that is, or a subset of thereof, which is a period of rapidly rising or soaring asset prices with low volatility. And from a quantitative perspective, we define that as a period of trailing returns of 30% or greater without any intervening 10% plus correction, right? So that happened from starting at the end of the wolf market of 12/8/2023 until December 23rd of 2024. So it lasted about a year, right? It was a very strong eagle market during that time period. Not long thereafter, we reached what we would later learn was the peak of that bull market. So on February 19th of 2025 of this year, we reached the peak of our prior bull market, which had started October 13th of 2022. Right? How did we know that was the peak? Because following February 19th, we descended into a bear market, which was confirmed on April 7th of 2025. All right, so this was following the Liberation Day tariff announcements, right? So at that point, again, all of these things, all these market types I'm talking about, bear, bull, wolf, eagle, you only know that you have been in them in arrears once quantitative confirmation has occurred. All right, so you don't know what market type you're in with any definitive way until it has already passed, right? It has already been confirmed quantitatively. All right, so on April 7th of 2025, we hit a 20% decline from our prior, for the record peak price, which is the traditional definition of a bear market. It's a cumulative decline of 20% or greater, right, from a record peak. So that told us we've been in a bear market since February 19th of 2025, and also told us that was the peak of the bull market that started October 13th of 2022, if that makes sense, right? Okay. What is interesting about this particular bear market that occurred earlier this year, is that on April 7th of 2025 this year, we confirmed a 20% decline from a top on an intraday basis, but not on a closing price basis. That's one thing that's interesting about it. Another thing that's interesting about it is that it turned around on the same day, right? And went back up to achieve its prior record peak, and that occurred on June 27th of 2025. So this was a very short, very abrupt bear market with a very rapid recovery, right? So basically we had this rapid decline until April 7th. We reached a maximum drawdown on an intraday basis of 21.35%, but on a closing price basis, it just barely missed breaking 20%, right? And then immediately on the same day, it turned around and went rocketing back up, right, over the next 2+ months to re-achieve its prior record on June 27th of 2025. So that is a new critical date for us to assess what is going to happen going forward. These two dates, April 7th, 2025 and June 27th, 2025. And why that is, I'll get to in a moment. Okay. Since then, since June 27th of 2025, it has been up to the current all-time record high price on the S&P 500. That occurred so far on October 29th. So just a couple weeks ago, 2 weeks ago, almost exactly, right? So that time period from bull indication on June 27th until October 29th is exactly 4.13 months. And during that time period, we had a gain of 12.57% from June 27th to October 29th. Since then, we've been waffling around a little bit over the last 2 weeks plus. And we've had a maximum drawdown like from that October 29th peak of about 4%. And it has since come back. As of the close of business yesterday, we were down exactly 1% from the prior record. And I know today, this morning, it was down a little bit lower. It was down about 70 basis points. And I'm not sure what it is at this particular moment, but we'll see where it closes. So it's probably end up down, closer to between 1% and 2% by the end of the day. Okay, so that is what has happened. What has also happened, I failed to mention here, is I said what happened from bull indication until October 29th, but what has also happened is, another way to measure this is from the bear trough on April 7th. Between that point and October 29th, we've had 6.83 months have elapsed, and we've witnessed a gain of 43.13%. All right? So that is what has happened. Now the question is, what does all this mean for us, right? Because it does mean a number of things. Nick, if you could just pan over here, please. Okay. So historically speaking, one of the things we do here at 4Thought is we go and we actually just recently published a new white paper article on this. That is updated from a 2018 version of it that was also published in the Journal of Financial Planning, or a version of it was published in the Journal of Financial Planning. The updated version, which includes new information, which I think is very interesting and telling about, in terms of useful portfolio management research. I would encourage anybody who has any interest to download that from our website and take a look at it. It's available now. But in that white paper, what we do is we go back and look at the history of the S&P 500 since 1950 up through April 7th of 2025. So about 75 years of history of the S&P 500. And we break down the history of the S&P 500 on an intraday basis, which is like the most in-depth way you can do this, into all of its constituent parts that I mentioned earlier. Bear markets, bull markets, wolf markets, and eagle markets, and all of their historical occurrences during that time period. And we measure them in great detail. So what do all those measurements tell us? I'm going to give you some of that information right here. All right, so one of the things that we can draw from there is looking at bull markets, the traditional bull market, right, from trough to peak. And if we look at the average length of a bull market from trough to peak, the average is 3.97 years, so about 4 years. And on the short end, the shortest in history was 1.15 years, and the longest was 9.55 years. So a broad range, but the average is 3.97. Okay, the average gains during a bull market from trough to peak is 128.07%. Right? This is taking all the bull markets throughout the history of the S&P 500. On the low end, the smallest amount of gains were 44.62%, and the largest was 341.05%. So more than a tripling of the value. All right. What does that mean for us now? So if we look at it from the standpoint of, if we look at April 7th of 2025 as the beginning of the current bull market, well, so far, if we look at from trough to peak, let's assume October 29th, 2025 were the peak, right? Extremely unlikely. And the reason being, it has only been 6.83 months, and we've only had a gain of 43.13%. Whereas, on average, the gain is an additional 4 years, again, versus 6.83 months, and the average gain is 128.07 versus only 43.13%. Even at the low end, right, if this were to be the peak on October 29th, this would be the shortest bull market in history. It would have never occurred previously, right? Because we only got 6.83 months, and The shortest in history was 1.15 years, right? So almost double, right? The length of what we experienced so far. And the shortest or the smallest gains were 44.62%. So far, we've seen only a maximum of 43.13%. Right, so that's closer, but even so, if this were to turn around now, it would be the shortest bull market in history, which makes it extremely unlikely. It would be outside the data set, effectively. It would be an outlier, right? That's looking at it from that perspective. Now, another way to look at it is from the point of indication of bull market until the next peak, right? And if we do that, we look at that historical data, then we see, Mick, if you could kind of zoom in over here, hopefully people can see this a little bit. I'm going to read it anyway, but the average time after indication of a bull until the peak preceding the next bear market is 2.19 years. So far, we have had 4.13 months. The shortest was 6 days, and the longest was 7.44 years. So a very broad range, right? Again, but still we are very far below average, right? The average gains in terms of performance, cumulative over that time period, the average is 49.75%, right? With a minimum of 2.09%, a maximum of 225.74%. And so far, we've seen only 12.57%. All right, so if you're looking at, anything can happen in terms of the extremes, right? If you look here, but even at the extremes, this would definitely be, it would not be the shortest time period in history, but it would be very close to it. And if you look at it in terms of the averages, it's a quarter of the averages, less than a quarter of the average, right? So again, this tells us, based on averages, at least, that it is extremely unlikely that October 2019 was the top of this bull market. Furthermore, as a side note, right, if you look down here, Mick, I also just for curiosity's purposes, I looked at, okay, what if we looked at this and we said, yeah, this is a bear market, but it was almost barely a bear market. So maybe you could think of it as a correction in the broader bull market that started as October 13th of 2022. This is not the way we think of it, by the way, but you could make this argument. If you made that argument, then from October 13th of 2022 until October 29th of 2025, that's 3.04 years and a gain of 98.2%. Okay? Now, going back to looking at bulls from trough to peak, the average is 3.97 years. This would have only been 3 years. The average gain would be 128.07%. This would only be 98.2%. So even if we looked at it from that perspective, which is not our base case at all, but even if you did look at it from that perspective, we're still probably just in the second half of or I shouldn't say that. We would still be below average in terms of the average length of a bull market. So the probability, from any perspective you look at it, the probability of October 29th of 2025 being a peak of this bull market is extremely, extremely low, right? Anything is possible, of course, right? This could be a historical outlier. That is entirely possible. Right? Things do change the averages. They do change the extremes when new events occur over time. But it would be extremely unlikely to be the case that is a top, right? Okay, so all that sounds very positive, right? Super positive. There's more to the story, though, right? Not everything is roses here. Okay, other things that we can look at are, we talked about wolf and eagle markets, right? So what we are now most concerned about is the potentiality of a wolf market over the intermediate term, right? Short to intermediate term, I should say. So, Nick, here, if you look at this, again, looking at the historical data on the S&P 500, everything going back to 1950, we see that if we look at the time, the average elapsed time between the trough of either a bear market or a 10% plus correction, and the peak preceding a new bear market or 10% plus correction. The average time, if we take all those instances together, of which there are many, it's a large sample size, pretty large sample size. The average time is 1.1 years, or 400 days, like 13 and a half months, right? Before you get another drop, effectively, another drawdown. The shortest in history was 1 day before that started to occur, and the longest was 5.62 years, so extremely broad range, but the average is 1.1 years, and in this particular case, if you look at this data set, a histogram of this data set, do a probability distribution curve on this, this tends to have a pretty normal distribution, meaning that things tend to cluster around the average, right? So they tend to fall within the range of 6 months, the average being approximately 1 year to about 1.5 years, right? So that the data set tends to cluster around there, which means this is probably a more reliable predictor than some of the other items we have up here. Given that that's the case, well, look where we are so far. On April 7th of 2025, between then and October 29th of 2025, we have an elapsed time period of 6.83 months, right? Versus the average being 1.1 years. And like I said, it tends to cluster around the 6 month to 1.5 year mark, with the most around the 1 year mark. Right? So what this means is we have to start thinking about the potentiality of a wolf market, which involves, as I said earlier, a 10% plus correction plus the recovery back to the pre-drawdown price. Right? So that's our biggest concern at this point. But if that's our biggest concern, we shouldn't be too worried, right? So get to that. Other things that we want to look at here, again, if you could just pan down over this way, please. Another perspective from which we look at the financial markets in terms of measuring them is based on probabilistic analysis, right? So probabilistic analysis, what that means is we take a whole set of different asset types, and meaning like very similar to the asset types we went over earlier in terms of different types of stocks and bonds, and we measure those on a daily basis, and we determine probabilistically, we do what's called a probability distribution curve measurement on each of them, and we determine how far each of them are away from their long-term averages, right? Their recent data and compared to long-term historical data, effectively, is what we're doing. And we're determining how far above or below their long-term averages they are. And we compare them to themselves, and then we rate them and compare them to all of the other asset types, right? And this gives us an idea of where the markets lie, whether they are over or undervalued. All right, so for example, if an asset type is its most recent returns are substantially above its long-term averages, that means it's probably overvalued to some degree. Whereas if its recent returns are substantially below its long-term averages, it's probably undervalued or cheap to some degree, right? And we can actually measure the degree to which that's the case. Okay, so based on that probabilistic analysis, if we looked at stocks as a whole, and most stock types are ranging from slightly undervalued, right, so slightly cheap, not substantially cheap or moderately cheap, just slightly cheap, to moderately overvalued, right? When it comes to bonds, for the most part, are hovering around fair value and ranging up to slightly overvalued, right? So with both of these, there is nothing extreme here, right? Yeah, stocks tend to be slightly more overvalued than bonds, depending on which type of stocks you're looking at. In particular, the international stock markets tend to fall in this moderately overvalued range, where something like U.S. mid-cap stocks tends to be in this slightly undervalued range. And bonds are all clustering around this, fair value to slightly overvalued range. All right, so there's nothing to really be that gives us any real directional information here because nothing is extreme enough for us to take us, any significant bet on. Right? Okay. So in summary, we have a bear trough that occurred on April 7th of 2025, which is the same day that the bear market was indicated. It was also confirmed only on an intraday basis, but not on a closing price basis. All right. The bull market, the new bull market, was confirmed on June 27th of 2025, of this year, which means there was an extremely rapid recovery, faster than normal, from the bear. Right. So this was a short bear. I've used the term before, a bear cub, as opposed to a sow bear or a big daddy bear, whatever you want to call it, a boar bear. This is a short duration and short and small drawdown bear market, right? Okay. Despite that, all right. So that being the case, we're probably still pretty early in the bull market cycle, probably very early in the bull market cycle based on historical data. However, a wolf market is becoming increasingly probable over the next 11 months because we're about 6 months to 7 months out from the most recent trough, and because of the reason I mentioned earlier, because we have this probability distribution curve, which tells us that these wolf markets tend to occur within that, the 1 year following the 6 month mark, you need to start thinking about a wolf market being probable during the next 11 months. And potentially beyond, if it went longer. Right. Come over here, please, Mick. Outcomes and actions. So these are things that we can actually take action on, either as portfolio managers or as investors. The first few are really for portfolio managers. Okay, so if we look at the stock market's outlook as a whole, all things considered, that means that in the short to intermediate term, our outlook for the stock market is roughly neutral, right? And the only reason it's neutral and not positive in the short to intermediate term is because of the potential for this 10% plus correction sometime over the next year. However, in the long term, or the intermediate to long term, following that correction, which will probably occur during that time period mentioned, our outlook is positive again, right? We believe this bull market, we're still in the very early stages in a bull market. So this is not something that the individual investor can take action on, but it is something that we as portfolio managers should be taking action on, right? So that's something we are doing. That means we are starting to prepare for a wolf market in the next 11 months, as I just mentioned. And one of the ways that you can do that, or some of the different things that you can do to make that preparation, have to do with the different market types I mentioned. So in the previous session, we talked about the different methods of investing, strategic asset allocation, liability-driven investing, opportunistic investing, and selective or concentrated investing. Each of those has a specific market type in which it tends to outperform the others in, right? So liability-driven investing does best in a bear market. Strategic asset allocation, again, this is based on our own proprietary research. It can be the white paper that was just updated and posted. Liability-driven investing associated with bear markets. Strategic asset allocation associated with broader bull markets. Opportunistic investing associated with wolf markets. And selective or concentrated investing associated with eagle markets. Given that we are beginning to prepare for a potential wolf market, this means that we are suggesting and we are applying for our clients and allowing overweights to opportunistic investing, because we expect that to be the next most likely phase of the broader market cycle. Doesn't mean we're wholesale moving everything into that, just means that we're gradually transitioning portions of people's portfolio into a larger weighting to opportunistic investing. We are underweighting selective or concentrated investing, because that does not appear to be, usually selective or concentrated investing tends to follow a wolf market, not precede it. That may or may not be the case here. They can come in different orders. They don't necessarily always follow the same order, but statistically speaking, if you look at the history of the S&P 500, eagle markets are most likely to occur following a wolf market. So we're not there yet, For that reason, we're underweighting selective or concentrated investing, and we're neutral on strategic asset allocation and liability-driven investing. What that means is the investor portfolio should not be heavily skewed one way or another to stocks or bonds, right? You want to be making a tactical decision to skew a person's long-term allocation of stocks or bonds in one way or another at this point. There's no reason to do that. It's a matter of simply allocating their portfolio for the most part based on what their objectives for risk and return are, right? In the long term. So no reason to make any major shifts there. Other things that we can look at, I talked about probabilistic analysis and the different market segments, right, or asset types. If we look at those relative valuations based on those distribution curves, then U.S. mid-cap stocks look like the cheapest option out there right now in terms of a bargain buy. But even they are only slightly undervalued. They're not heavily undervalued. It's not like you're going to buy at basement dirt cheap prices here. And then international developed market stocks are the most expensive, and I would say that they're not extreme. They're moderately overvalued, but they're significantly more expensive than U.S. stocks. All right, and emerging market stocks are not far behind, partially because of what we showed before in terms of the year-to-date performance. They've come a pretty long way in a short time, and as a result, they're looking more expensive than U.S. stocks. Okay, so what does this tell us? So those are all things that a portfolio manager can take into account, and these are things that we are doing inside the portfolio, right, for our clients. But this is not something that clients can really take action on. What can clients take action on? So there are two things there, and there are two types of clients basically, right? Broadly speaking, there are growth investors and there are income investors, right? Meaning that we're accumulation phase and distribution phase, more succinctly, right? Accumulation phase meaning they're in their earning years, they're still accumulating assets for their future retirement, whereas distribution phase meaning they have already pulled the trigger, they're done with their earning years and they're in retirement, they're taking income from their portfolio to supplement whatever income they get from Social Security or pensions or otherwise. All right, so for growth investors, because of the fact that there's nothing extreme here, we're not expecting any huge drawdown in terms of a bear market or anything like that, and we're not in the midst of a correction yet, although we do believe that will be coming sometime over the next year. There's nothing that growth investors should do other than what they would normally do. So they want to make a neutral, systematic investment into their portfolio. So basically what that means is you do an analysis of their earnings income, of what their living expenses are and what their taxes are annually, and what comes out at the bottom is what they have available to save, and that is the amount that they should be putting away into their 401k plan and other savings and investment plans on a systematic basis. All right, so there's no reason to over contribute in that regard or under contribute in that regard. Just basically do the calculation and follow it. That's very simple, right? That being the case, you also, although we're preparing for a wolf market, it does not appear to be that it is imminent. It's not like we're a year and a half out from a trough and it's coming at any moment, right? It's just a matter of gradually preparing for what's coming in the future. So that being the case, there is no worry. They should have no second thoughts about deploying any excess cash they may have from bonuses or otherwise. Normally, there's no reason to dollar cost average in or anything like that. If they have excess cash that's not meant for use in the short term, it can be used for long-term savings and investment. That should be deployed immediately into the portfolio. No reason to wait. No reason to dollar cost average. Just get it in the market. Get it into your portfolio. Income investors or distribution phase investors. Similarly, just at the inverse, right? You want to take neutral withdrawals, right? You want to take too heavy of a withdrawal from your portfolio or too light of a withdrawal from your portfolio. Same process, right? You calculate your necessary portfolio income need, and whatever that number is, you take that neutral amount in. Not too little, not too much. Same concept. However, on the flip side, for income investors, if any of those investors that over the course of this drawdown, this short bear market that we experienced recently, they decided, based on our advice or based on their own volition, to minimize their withdrawals during this time period, which was advice we were giving during that time period, and live off a portion of their cash balance to maximize the money they had in their portfolio so that they could take advantage of an upturn if and when it did occur, which it did. Some of those people may be short on cash in terms of their standard cash liquidity fund, which typically you're talking about 3 to 6 months of living expenses that would normally be in that part of their portfolio in bank savings accounts and checking accounts, for example. If they are short on what that number is right now, this is not a bad time to take some of those gains and shore up that portfolio, right? Fill it back up, top it up, make sure you've got your security blanket, so to speak, in terms of cash, so that if and when a downturn comes, you're not worried about it, right? As a distribution phase or retired investor. So that, in a nutshell, is where things stand. That wraps up our financial markets update. As usual, I just want to let you know that about what we do here at 4Thought. Most of you are aware of this at this point, but I'll just briefly. This is the commercial part of the presentation, right? So at 4Thought, we are an independent SEC registered investment advisor. We are not owned by any larger firm or affiliated with any other firm that tells us what to do. We don't have any broker-dealer relationship. We don't even allow any of our advisors to hold a Series 7 license. We're a Series 65 license only. We are fee only, which means we can be more independent, more objective, and much less biased when working with clientele. So that's important to know. That's a big part of our conscience as a firm, right? And our approach as a firm. We want to make sure that our incentives are aligned with the objectives and goals of our clients, and that we are working together, and we are not it's not an arm's length transaction. We are both moving in the same direction. That being the case, the things we do, as most of you know, we do investment advisory, our portfolio management in the form of separately managed accounts for our retail clientele and for third-party firms as well. We refer clientele to us. And we run our portfolios algorithmically. We run 10 different separately managed accounts, which conform to the approach I mentioned earlier, using the 4 different methods and this concept of multi-method investing and blending portfolio, different aspects of portfolio management together to get the best possible outcome for our clients. We are rated and ranked by Morningstar for those purposes. Right now, we just got our new numbers in for the end of the quarter. We have, out of our 10 strategies, overall rankings for, we have a 10 plus year track record for most of these except for one, which has about a 7-year track record. And 2 of our strategies are ranked 5 stars out of 5. 5 of them are ranked 4 stars out of 5, and 3 of them are ranked 3 stars out of 5. So we have nothing below a 3-star ranking or rating, and most of our stuff is ranked 4 or 5 stars and hovers back and forth between those 2 ratings. So keep that in mind. We believe we can do a great job for your clients, right? Secondarily, we also do, for those clients we're doing portfolio management for, we also do retainer fee-based financial planning and wealth management, which means we not only manage their portfolio, we also do their investment planning for them in terms of retirement accumulation planning, educational planning, other goal-based planning, etc. We do their estate planning for them in terms of wills, trusts, and charitable giving. We do their business succession planning for business owners in the event of that they retire, become disabled, or die. Then we do fringe benefits planning in terms of looking at employer-employee benefits, and we coordinate all those things for that client on a retainer fee basis. As an adjunct to that, right, I mentioned the fringe benefits, right? So part of that is retirement plans, right? And that's another thing we do here as a firm that you can take advantage of, right? So we have our own qualified retirement plan program that we've designed from scratch. where we act as the 338 fiduciary investment manager and record keeper, which means we install 401k profit sharing defined benefit plans in businesses, and we manage them soup to nuts in coordination with a third-party administrator who does the tax reporting on the plans. And that incorporates everything we talked about so far in terms of the different separately managed account strategies and all those star ratings, all that performance that I mentioned. Those are all incorporated in those plans as well. So if you have interest in that, if your clients have interest in that, please contact us.